Hello, my name is Anthony Siccaro, founder and president of Providence Financial and Insurance Services, located in the heart of the San Fernando Valley in Woodland Hills, California. And I'm also host of the Providence Financial Retirement Show, which airs every Saturday on AM 870 KRLA The Answer. It's a Southern California station. And I wanted to do another periodic market update. This is something I try to do on an as-needed basis, usually at least a couple times a month, and just update my clients and update anyone watching this video with regards to what's really going on out there in the economy and what's really going on with the markets in general. And recently, ever since Trump got elected and ever since Trump got inaugurated, the market's done really well. And I've had a lot of people ask me, should we be in? Did we miss out? And really they're kind of feeling guilty. They're kind of feeling like, oh my gosh, I missed the boat. And, what are we doing? And they're thinking about, maybe repositioning their assets to something a little more aggressive. And in all fairness, I think that'd be a big mistake, but I want to talk about that. I want to put it all in perspective and kind of let you know my thoughts about it. Now, if you're a client of mine, you know that we focus on income. We focus on helping our clients earn a 4 to 7% rate of return without the risk of the stock market in portfolios that are much more conservative. And of course, the market's gone up a lot recently, and it's easy to feel like maybe you've been left behind because we don't have a lot of your money or any of your money in the market, depending on on your portfolio. Now, I want to talk about that for a few minutes. Well, let's talk the shorter term. And I'm going to focus on some notes here, some numbers that I jotted down, so forgive me for looking away. But let's focus on the short term. Let's focus on what's happened from the inauguration to now and what's happened from the election to now. So on election day, Tuesday, November 8th, the Dow Jones was at 18,300 and change. And between the election and the inauguration, the Dow went up to 19,800 and change, which is good for an 8.2% growth between the election and the inauguration, 8.2%. And then from the inauguration, January 20th to March 8th, which is close of business yesterday, the Dow Jones grew from 19,827 to 20,855. And you'll remember that it crossed over 21,000 for a little while, and then it's back down to 20,855. And so that's good for another 5.2% return from the inauguration until March 8th. So a grand total of 13.8% return, which is what the Dow Jones has grown from the election to now over the course of the last 4 months, from November until March. And it's that 13.8% that people feel like they're missing out on. It's that 13.8% that is causing people to wonder whether they're allocated properly or whether they should be doing something else. But that's a very micro perspective. That's a very short-term perspective. And Wall Street wants you to focus on the short term. They want investors to have short memories like they do. And that's the reason is because it's easier to short. It's easier to think about the short term and easier to remember the short term than to think about the long term. So let's go back in time a little longer duration. You realize that if we go back to between March 6th of 2015, the Dow Jones at that point was 17,800, and November 4th, close of business before the election, November 4th, the Dow Jones closed at 17,800. And there's some change in there as well, too. But March 6, 2015, Dow Jones, 17,800. Fast forward a year and a half, November 4, 2016, Dow Jones, 17,800. How much growth is that? 17,800, 17,800, year and a half. How much growth? None. Zero. There was no growth over that year and a half, even greater than year and a half time period. So Wall Street doesn't talk about that. They don't focus on the fact that if you had your money this whole time, you earned nothing during that time period. Well, what about if we go back further, you say? Well, let's go back further. Let's go back far. Let's go back to 1999. What you're going to realize is that from 1999, December specifically, the Dow Jones was at 16,000 and change, 16,500. Fast forward to October of 2013, 13 years later. The Dow Jones was at 16,100 change. It was actually lower by 400 points 13 years later. Now let's just call it even. It was even 13 years later of absolutely no growth. So 1999 to 2013, zero growth at all. Now from 2013 to now, 2013, we've gone from 16,167 in October of 2013 to our current level of 20,855 at this point. So all the growth that has happened in the last 17 years, every penny of it, has all come from 2013 to now, because from 2000 to 2013 there was zero growth. Okay, so it's all grown. Now, if you just look at how much has the market grown from from 2013 to now, well, it's going to be a skewed number. Unless you bought in at the low in 2009, then it's going to be a skewed number. If you do what Wall Street tells you to, you buy and you hold. You don't buy and trade and sell. You don't sell options. You don't short the market. You buy and hold. If you've bought and held for the last 17 years, from 2000 until 2017. Why 2000? Because that was when the market hit an all-time high. The market had come through the 80s and 90s and done really well during that point, but in 2000 it hit an all-time high. And if you had money in 2000 that was in the market and you've just held it there, from 2000 to 2017, you care to guess what your overall rate of return is for the stock market for that entire 17-year period? Would you be surprised to know that's 1.35% rate of return? 1.35%. Is that a good rate of return? It's not. But guess what? Along the way, there's bumps and bruises, and there's good times, and there's bad times, and there's things like this, things like the last 4 months of 13.8% growth. I think we said they've happened before. They've happened, but you know what? The market can go down 13.8% in a moment's notice, and that whole 13.8% can be vanished. There are 3 times in the last 2 years where the market has dropped 10% or more in a matter of a week. And of course, it's recovered. But you don't want to focus on the 13.8%. You can't focus on the 13.8% because that can be gone in a heartbeat. So the reality is that my clients during this entire time period have been earning that 4 to 7% rate of return year after year after year after year after year. We're not trying to help our clients get rich. We want to make sure that they never go broke and stay pace with inflation. And that's what happens when you invest for income. You have to look at the risk versus reward when you're looking at the stock market. Historically, the historical evidence tells us that the market probably has another 30 to 70% correction at this point, based on historical evidence. And if you want to learn more about why I say that, I've got a video just on that. It's called Market History. Go search our YouTube channel, find my market history video, and I spend, I don't know how long the video is, 20 or 30 minutes, talking about the historical cycles, talking about the trends, talking about what history teaches us about where the market could go from here. Go find that video, Market History, and you'll see that generally speaking, we have the market history tells us that there's probably a 30 to 70% drop coming. So you then have to look at the risk versus reward to find out whether it makes sense to even be in the market at this point. So let's say it this way. I don't think that the market can go much higher than it is right now. And we're going to talk about that in a few minutes as I wrap up this video. But I ask people this question every day for many, many months as to how much higher they think maybe the market could go. And oftentimes, months ago, I was saying that, I'm willing to say that the market goes up another 20, 25%. Now, that was before we've had this 13.8% run. I don't really think we can go a lot much further than now, but maybe we do. Maybe we do. Maybe we even go up another 20% from here. Let's just say that that's going to happen. And if you're watching this video, I can tell you from experience that 90% of you are believing that that's probably not even realistic at all. But let's say that it is. Let's say that a 20% increase from the market from where we are right now is possible. And, well, that's the upside. That's the reward. Well, what's the potential risk? Well, if you watch my market history video and you realize that we could have a 30 to 70% drop, and I actually think it's going to be in the 50 to 60% range from here, then the downside could be 50%. 50%. So 20% upside, 50% downside. Is that risk of losing 50% worth the reward of gaining 20%? Only you can answer that question. Some people gamble. Some people want to gamble with their retirement. Some people don't. Let's put it this way. Speaking of gamble, let's say that we go into a Las Vegas casino and you and I are trying to figure out how to, whether we want to play this game. And here's how the game works. You bet $100, and if you win, you walk away with $120. But if you lose, you walk away with $50. If that's how the game works, would you ever sit down and play that game? I can tell you unequivocally that I don't think I've ever talked to anyone that would. Why? Because the reward of winning $20 is not worth the loss of losing $50. It's not worth it. Now, if you're a gambler and it is worth it to you, fine, then play it. But if you're saying, no, there's no way I would ever play that because the reward's not worth the risk, then the question is if you wouldn't play that game with $100, would you play that game with your entire retirement portfolio? Because I think those are the same odds that we have right now with the U.S. economy. Maybe we do go up 20, 25%, but certainly we have the ability to go down 40, 50, 60%. The risk is not worth the reward. And regardless of what the stock market does, the right move is still the right move. You know, in Las Vegas, there's blackjack. And I know a little bit about blackjack. It's odds, and we deal a lot with odds. But the bottom line is you have blackjack in Las Vegas. And every single combination of cards has a right move. When the dealer has a certain card that is showing, and you've got a certain two cards, for every single possible combination that exists in the game of blackjack, there is one right move and one wrong move. Now, what's the difference between a right and wrong move? Well, a right move is a move in your favor, a move where the odds are in your favor, and a wrong move is a move where the odds are not in your favor. So if you make the right move, are you always going to win? No, of course not. But the right move is still the right move. And over the long run, over playing for a long period of time, your odds are in your favor by making the right move. And that's how Vegas makes money, all based on odds. And you know that as well, too. And by the way, the odds in blackjack are really very slim. It's my understanding that it's a 48% chance to you to win and a 52% chance to them to win. So that 2% margin by them doing the right thing every time, is in fact what causes the house to win over the long run more than the short run. And that's why the dealers have rules. Guess what? The dealers don't get a choice of whether they're going to hit on a soft 17 or not, right? The dealers have to do certain things. Why? Because everything that they have to do is in the house's odds, and they have a 2% edge on you. But that 2% makes them, millions or hundreds of millions of dollars over the course of lots of players, lots of days, lots of time. So hopefully that makes sense. Same thing with the market. Clients that are in the market, clients that are not in the market, rather, my clients that are earning 4, 5, 6% rate of return consistently, persistently, still the right move. You can't look at the market and go, oh my gosh, we shouldn't have done it. It's still the right move. When we do have this correction that I strongly believe is coming, as you know, if you know me, you're going to be very glad that you are with you are. Meanwhile, over the last 17 years, from 1999 to now, the market's done 1.35% return, whereas if you would have had an investment that would have paid 5% a year for that entire time period, you would be way ahead. As a matter of fact, I'll tell you that if you go back to 1999, do you realize that you could have bought a 6% FDIC insured CD in 1999 for 15 years? You would have been way ahead of the market knowing what we know now. Don't let this 13% or 13.8% throw you off of your game plan. Don't let it mess with you mentally, even though it's messing with all your friends. The right move is still the right move. Let's wrap up by talking about one more thing. This video's turned out to be longer than I've expected, but let's talk about one more thing. Let's just talk about the Trump bump at this point. And my worry is that the Trump bump becomes a Trump hump. On a hump, right, ends at some point and starts going down. And that's where I think we are. The challenge with Trump, and the reason that the market has gone up today is because of all of Trump's promises. The market is up today based on what's been happening for the last 4 months and based on his promises leading up to the election. He made a whole bunch of promises and the market's priced that in. If at this point all of those promises come true, if he does tax reform, if there are no trade wars, if he rebuilds the military and does everything he says and everything that the market's priced in, if every single one of those things comes true, guess what's going to happen in the stock market? Probably nothing. Why? It's already priced in. Everyone's kind of expecting that to come true. But here's what I find very funny, and a lot of economists and analysts I've spoken with have come up with the same conclusion. Here's what I find very interesting. The fact is that the market's not pricing in what happens if none of this stuff comes true. What happens if he realizes that he gets a lot of pushback from the Republicans and he can't pass tax reform like he wanted to? What happens if Obamacare falls flat on its face? What happened, or the repealing of Obamacare, right? What happens if all of a sudden there's a currency war, a trade war that starts with China, which we haven't even talked about, or Mexico, right? What happens if a trade war starts? What's going to happen? None of that is priced in, which really boggles my mind. So I think we've got to be prepared for choppy markets. I think that, could be a problem for the future. I think it definitely could be a problem long term, and something that starts an avalanche. And that's my fear is that one snowball starts rolling down the hill, and if it picks up speed, that one snowball can start an avalanche. And you realize we're in the second largest period of time where the market has grown as fast as possible in history, from March 9th, 2009 to here we are in 2017. That's the second fastest growing time period in history, the entire history of this country. And just from a common sense standpoint, if you see something start to go up and it goes up a little faster and then it goes up really, really, really fast, what's likely to happen next? Common sense says it's likely to come crashing down. And from March 9th to now, the market's up over 300%. You tell me, in the last 9 years, is that slow growth or is that rapid growth? Very fast growth. So when you kind of put it all together, it really points to the fact that we probably still have some problems ahead. And I don't know whether we're talking 30% problems or whether we're talking, another major calamity like some people are predicting, another depression. I don't know. No one knows. That's speculation. But the odds are that we have problems ahead. And do you want to bet your entire retirement savings on the slim possibility that this is the first time in history that the market doesn't crash from here 30 to 70%? Or do you want to bet your retirement savings and your life savings and everything you worked hard for on the odds, on the probability that we have some problems ahead? Only you can answer that question. My clients have answered the question that they want to go with the odds. The right move is still the right move. Don't feel bad. You guys are still in great condition, still in great shape. You're still earning that 4 to 7% rate of return on your portfolio. And there is no regrets on my part and should be no regrets on your part. So with that, I'm going to wrap that up. If you're a client of mine, thank you for being a client. I don't take that responsibility lightly. If you're not a client of mine, thank you for watching this video. If you have any questions, don't hesitate to call me at the office. The number here is 818-887-6443. Or you can look us up at providencefinancialinc.com. providencefinancialinc.com. And I would recommend that you follow us on YouTube. If you're watching this somehow, just click follow, and you can follow us on YouTube. And at the same time, like us on Facebook, and we try to keep post dated as well too. So thanks for listening, thanks for watching, and God bless.